We're making a fortune with tariffs, $2 billion a day. Do you believe it? I was told $2 billion a day. Many countries have taken advantage of us, the likes of which nobody even thought was possible for many, many decades, for decades. We have a deal with some very good people, some very rich companies that would do a great job with it, but we're going to have to wait to see what's going to happen with China.
What would happen if China stops buying U.S. debt? For decades, one of the most talked about aspects of the global financial stage has been China's massive investment in U.S. government debt. Remember the days when China was hailed as the top holder of U.S. debt, even outpacing some of America's closest allies? To unravel this, let's first break down what U.S. government debt actually is. Essentially, when we talk about U.S. government debt, we're referring to the securities issued by the Treasury to finance government obligations. These come in various forms: short-term Treasury bills, medium-term Treasury notes, and long-term Treasury bonds. Collectively, they're known as Treasuries. Other players in this vast market include Japan, various foreign nations, pension funds, central banks, and even domestic American investors. So why are U.S. Treasuries such a hot commodity? First off, they're considered among the safest investments around, with minimal risk of default. Plus, the U.S. Treasury market is huge and incredibly liquid. This means that if China ever decided to offload billions of dollars worth of treasuries overnight, there would be a ready pool of investors with deep pockets to snap them up. Thirdly, another key factor is that the US dollar stands as the world's primary reserve currency. Central banks around the globe hold a significant portion of their foreign exchange reserves in dollar-denominated assets. With these reasons in mind, it's clear why China chose to pile up US treasuries. But that's just the tip of the iceberg. Now let's dive into how China evolved into one of the largest holders of U.S. Treasury securities. The story begins in the early 2000s when China's economy was on a tear. During this period of rapid expansion, China became the go-to destination for global investment. As American investors, European conglomerates, and East Asian companies flocked to set up factories or forge partnerships with Chinese firms, China raked in enormous amounts of money through international trade. By exporting a huge share of the world's goods, China accumulated a staggering volume of foreign currency, primarily US dollars. Check out this graph from the World Bank, which highlights how swiftly China's total reserves surged, reflecting its massive trade surplus. Simply holding these reserves in a bank wasn't enough. China needed to put them to work. And what better option than investing in a safe asset like US Treasuries? That's exactly what the People's Bank of China, PBOC, did, strategically purchasing U.S. Treasuries to earn a return on its vast reserves, while capitalizing on the safety and liquidity they offer. Over time, these holdings grew at a staggering pace. Imagine a graph spanning 2000 to 2008 that tells a story of foreign ownership of U.S. Treasuries. Right from the outset, Japan stood out as the dominant player. As a major economic powerhouse in Asia, Japan consistently generated a huge trade surplus with the U.S., and like any smart investor, it had to put that money to work. In 2000, Japan's holdings of U.S. Treasuries exceeded $307 billion, while China's were a modest $70 billion. Yet as the global economic landscape shifted, China began to catch up and eventually outpace Japan. By 2008, China's U.S. Treasury holdings had soared to over $700 billion, while Japan's increased from around $300 billion to more than $600 billion. Fast forward to 2013, and Japan's holdings peaked at over $1.3 trillion. However, since that high point, China's position has shifted dramatically. As of October 2024, China's U.S. Treasury holdings have fallen to roughly $760 billion. So, what's behind this significant decline in China's U.S. Treasury holdings? One of the key factors is China's ambitious Belt and Road Initiative. This vast, forward-thinking project aims to connect Asia, Europe, Africa, and beyond with an extensive network of roads, railways, ports, and pipelines, fundamentally reshaping global infrastructure and economic development. By channeling a portion of its substantial foreign reserves into the BRI, China is not only driving its own economic growth, but also strategically repositioning its investments in a rapidly changing world. Imagine a graph that tracks annual Chinese investments in the Belt and Road Initiative from 2013 to 2023. Each year, the figures are nothing short of remarkable. In 2018 alone, the investment surged past $50 billion, an amount that underscores the sheer scale of China's ambition. To fund these massive infrastructure projects and reach its lofty goals, China has strategically tapped into its vast foreign reserves. But the strategy doesn't stop there. Enter BRICS, a cooperative alliance of Brazil, Russia, India, China, and South Africa. This bloc of emerging economies was formed to counterbalance Western-dominated financial institutions like the International Monetary Fund, IMF, and the World Bank. In recent years, BRICS nations have collectively scaled back their holdings of U.S. Treasuries. By doing so, they aim to diversify their reserves, bolster the use of local currencies, and build financial systems that are less vulnerable to the fluctuations and policies dictated by Western powers.
And if the BRICS nations want to do that, that's okay, but we're going to put at least a 100% tariff on the business they do with the United States. You know what the BRICS is, right? You guys know.
Brazil,
you know what I'm
Russia.
saying, right?
Another significant move by China has been its deliberate accumulation of gold reserves. A corresponding graph shows that while China's U.S. Treasury holdings have been on a downward trend, its gold reserves have been steadily climbing. This dual strategy of reducing dependency on U.S. debt and increasing gold holdings not only diversifies China's financial portfolio, but also reinforces its economic sovereignty. By shifting its focus, China is effectively fortifying itself against potential financial shocks, whether these come from geopolitical tensions or international sanctions, ensuring that its economic engine remains robust in an ever-changing global landscape. Now imagine a scenario where China decides to slow down its purchases or even start selling off some of its existing holdings of U.S. debt. What might that mean for the United States? The answer isn't straightforward. While there could be significant consequences, the overall impact would also hinge on how other investors react. One of the most immediate effects could be seen in U.S. Treasury yields. In bond markets, prices and yields move in opposite directions. So if China reduces its buying, demand for these treasuries might drop, causing their prices to fall and yields to rise. This uptick in yields would, in turn, push up borrowing costs for the U.S. government. Another potential consequence is a shift in the value of the U.S. dollar. A large-scale sell-off by China, along with a reduction in its dollar reserves, could weaken the greenback. A weaker dollar might seem like a silver lining by making U.S. exports more competitive on the global stage, but it could also lead to higher costs for imported goods, ultimately affecting everyday prices. Moreover, such a move could send shockwaves through global financial markets. U.S. Treasuries have long been viewed as one of the safest investments, and any uncertainty around their stability might unsettle investors worldwide. However, it's important to note that the U.S. Treasury market is enormous, with daily trading volumes often exceeding $500 billion. This deep market might well absorb some of the fallout, especially if other investors continue to find treasuries attractive. Yet as China has gradually reduced its holdings, it signals a shifting landscape. The big question remains, what happens next if China stops buying U.S. debt altogether? And we'd love to hear your thoughts on it. Thanks for watching.